our previous two video trainings, we've talked about the critical reports that small businesses need to watch and look at on a regular basis. And in our last training session, we talked about the first report, which was your income statement, or typically referred to as a P&L statement. And in your profit and loss or P&L statement, we talked about the 5 things you need to be looking at each month. You need to look at your gross sales. You need to look at your cost of goods sold. You need to look at your gross profit. And then you need to look at your expenses and your net profit. Those are the 5 things you want to look at. And you might want to look at it in 2 ways. First, you might want to make some comparisons. Compare to what you did the month before. Compare to what you did the year before. So that's one way to analyze it and consider it. Another way is you could even set goals for yourself. What are your goals for gross sales? What are your goals for gross profit, and what are your goals for net profit? Those 3 areas are good areas to set goals at and track how are you doing to your goals. And so I hope you're looking at your profit and loss statement and paying attention to it and thinking about ways to improve it, starting with improving sales, controlling costs of goods, making sure you've got a good gross profit margin, controlling expenses and overhead, as it's oftentimes referred to, and then maintaining a strong net profit. And of course, the net profit is the money that you can use for whatever you want to use it for. You can reinvest it, you can pay off debts with it, you can buy equipment with it. There are a lot of different things you can do with your net profits. And again, talk to your CPA so that you don't get stuck with unnecessary taxes based on your profits. In this session, I want to talk about the other 4 reports, and particularly I want to talk about that second one called the balance sheet. And you have an example of a balance sheet there for Widgets Incorporated. And the 3 things that comprise a balance sheet are assets, liabilities, and equity. Assets are the things you have, liabilities are the things you owe, and equity is the difference. And so in assets, that's where you look to see how much cash do we have. And by the way, a balance sheet is always a look at a given point in time. So your balance sheet could be any day of the month for the month, or actually it's not related to time frame, it's just on that day. On that day, this is what you had. And so when you look at it, most people look at it on the last day of the month to just see where they were at the end of the month. And you want to look and see how much cash did I have on hand, and what did we have in accounts receivable, people who owed us money, because hopefully we're going to get that money and that's going to be cash for us. And then if your business is one that has inventory, you'll track your inventory, and the value of your inventory will be recorded here. And then that'll give you, again, another place to liquidate if you need more cash. And then the other thing that is not as easy to liquidate is called fixed assets. And fixed assets are those hard things like property, buildings, automobiles, or large equipment. They're fixed, and so they have value, and you want to count those as part of the value of your business. And so all of those items, your cash, your receivables, your inventory, your fixed assets, combined, that gives you your total assets for your business. And then the second section is liabilities. And liabilities are things like the bills you owe. We call that accounts payable. It's any notes that you owe on, any debts that you have, either credit card debts or bank loans or any other kind of notes you may owe on. They're recorded and accounted for there. And those things combined give you your total current liabilities. And that's something you want to be aware of. And then when you're thinking about what is my business worth today, in hard dollars, immediate hard dollars, this is not the valuation of your business, but how much equity do you have today? You simply subtract the liabilities from the assets, and that gives you your equity. And that's your balance sheet. That's your financial position at a given point in time. And so every month, I recommend that you look at your P&L statement, do some assessment, do some comparisons, maybe set some goals and track to those goals, and then look at your balance sheet and do the same thing. Do some comparisons either to the previous month or to the previous year, and or you may set goals for your assets and your liabilities, and make comparisons to your goals and the equity as well. So look at your P&L and look at your balance sheet every month. And then there are three other reports that I want to touch on. The next one is the aging report, or your receivables. And you've got an example there in your notes of why we call it an aging report, because these are the things you've billed out to your customers or your clients that are due currently, and then some of them don't get paid, and so they become 30 days old, and they fall under that column that says 30 days. And then some of those don't get paid, and they go 60 days, and they fall under the 60-day column. And then some of those may not get paid in time, so they fall under 90 days. And then most softwares just have it after 90 days. And hopefully your business is such that you're tracking your receivables so that they're not aging on you. You don't want them to get old. You want to collect your money. You're not a bank. You're not loaning your customers money. And so you want to collect all of your receivables on time. I was working with a client a while back, and she was struggling with cash. Cash flow was just such a challenge for her. And she said, "Can you help me with cash flow?" And I said, "Well, let's look at it. Let's look at your financials, and particularly, how much money do people owe you?" And she kind of dropped her head a little bit, and she said, "My receivables are pretty high." And I said, "How high?" And she showed me, and she had outstanding well over $100,000 in receivables that she hasn't collected. And I said, "What do you do with these customers who don't pay you?" And she said, "Nothing." And you've got to pay attention to that. You cannot let these things age without taking action. So if somebody doesn't pay you on time, you need to have a procedure. What are you going to do if they don't pay on time? Is it a letter? Is it a call? Is it an email? What's your follow-up plan? And if their account is 30 days old and they haven't paid, you need to take that first step. Usually, if they don't pay within 45 to 60 days, you need to take a second step of action. And if they don't pay within 60 days, or maybe 90 days at that point, you need to take a third. And typically, I say make your third your final step of action. And beyond that, you may want to take it to small claims court. But you need to collect your money. It's your money. You've performed services or you delivered products. And so make sure you're collecting the money that's owed you. That's why you look at that aging report. And I look at my aging report every week. That's a weekly report I look at. And I don't take action on it every week, but every month I take action on it. If something goes beyond 30 days, I'm letting them know your account's past due. If it goes beyond 60 days, I've got a second action step. If it goes beyond 90 days, I've got a third action step. I rarely have an account or a client that goes beyond that because they know you're paying attention. If you're not paying attention and you're not following up and asking for your money, they're going to forget you. They're going to forget about it. They're going to forget they even owe you money. And you're going to pop up one day and say, "Hey, you owe me money." And they're going to go, "What? I don't know what you're talking about." So pay attention to your aging report and stay on top of your receivables. The fourth report that's so important is your cash status report. And I think for some businesses, they look at this daily. If you don't look at it daily, you ought to look at it every week. And so the key things you're looking for there is, what's my bank balance today? In other words, where does my checkbook stand, really, or your general ledger? Secondly, what payables are owed to me right now, or that I owe. Payables are the bills that I've got to pay. What are my receivables? What's outstanding? And then if you've got a payroll, when is my payroll coming up and how much is it? Because you're wanting to look at those cash numbers. What cash do I have? What bills do I have to pay? How much cash can I anticipate coming in? And when I think about paying bills, the big one is oftentimes payroll. Am I going to make sure I have enough cash on hand to meet payroll? And so that's a cash status report that you may want to monitor either daily or weekly. And then the last one is the job profitability report. And simply that's just an individual job P&L. And so those are reports that if you use QuickBooks, it can generate all of them except the cash status report. You'll probably have to create that in a spreadsheet and keep that separate, or have your bookkeeper create that for you so you can kind of track that daily or weekly. Be sure you're looking at those critical reports so that you can manage your business by the numbers.